Yes, the U.S. public debt exceeding $37 trillion and the related money printing policies can be very costly, leading to significant economic risks like high inflation, a weaker dollar, and slower long-term economic growth. The dangers of high public debt. A high national debt can have a number of negative consequences for an economy and its citizens. When a government consistently spends more than it collects in revenue, it must borrow money to cover the deficit. This accumulated borrowing is the national debt. Higher interest costs. As the debt grows, so does the amount of money the government has to pay in interest. This interest spending can become a huge burden, diverting funds away from other critical areas like infrastructure, education, or healthcare. In fact, U.S. net interest costs have exceeded spending on national defense and Medicare in recent years. This creates a vicious cycle. The government has to borrow even more just to pay the interest on its existing debt. Crowding out private investment. When the government borrows vast sums of money, it competes with private businesses for a limited pool of investment funds. This increased demand for capital can push up interest rates for everyone, making it more expensive for businesses to borrow and invest. This crowding out effect can stifle innovation and lead to slower economic growth and stagnant wages over time. Fiscal crisis risk. The greatest long-term threat is a potential fiscal crisis. If foreign investors and financial markets lose confidence in the U.S. government's ability to manage its debt, they may become less willing to buy U.S. Treasury bonds. This could cause a sudden and sharp rise in interest rates, a drop in the value of the dollar, and a potential loss of the dollar's status as the world's primary reserve currency. The role of money printing in inflation. Money printing is a colloquial term for a process more accurately described as quantitative easing, QE. This is a monetary policy tool used by central banks, like the U.S. Federal Reserve, to increase the money supply and stimulate the economy. The Fed buys government bonds and other financial assets from banks, which in turn injects new money into the financial system. The link to inflation. A primary risk of excessive money creation is inflation. If the money supply grows faster than the production of goods and services, there's too much money chasing too few goods. This causes prices to rise, eroding the purchasing power of the dollar. The recent bout of high inflation in the U.S. has been attributed, in part, to a combination of unprecedented fiscal spending and the Federal Reserve's massive asset purchases during and after the COVID-19 pandemic. Devaluation of the dollar. When a country prints a large amount of money, its currency can lose value relative to other currencies. A weaker dollar can make imports more expensive for American consumers and businesses, further contributing to inflation. Historical examples. History is full of cautionary tales about the dangers of unchecked money printing. In Weimar Germany in the 1920s and Zimbabwe in the 2000s, governments resorted to printing money to pay their debts, leading to hyperinflation that made their currencies virtually worthless. While the U.S. is not in such an extreme situation, these examples highlight the catastrophic potential when a government loses control of its currency supply. The bottom line. While some level of debt can be a useful tool for a government to invest in its future and respond to crises, the current trajectory is a cause for concern. The combination of high public debt and a history of significant money creation carries a heavy price tag. If not addressed, this could lead to a future with persistently high inflation, a less powerful dollar, and a significant drag on economic growth, ultimately costing the American public a great deal.